Okay. Well, yeah. So what I thought I would do is I put together some slides. I had lots of help. Michaela and Jenny gave me some feedback, and then Elle and Landon and a bunch of other people gave me some more. So that'll just be a placeholder to sort of tee up the conversation, but it's really supposed to be a conversation. So if people have questions, ask them, right away. And then we'll see. I'm glad Michaela joined because she will keep us all honest, because I am not an expert by any means in tax savings. But let's see how it goes. Let me start sharing. Let's see why entire screen different for some reason. Okay, can you guys see my screen?
Mm-hmm.
Perfect. Are you guys able to see if somebody raises their hand or asks questions or something? Or is it all just my screen? I don't know. Anyway, we'll just speak up if you have questions. So first I wanted to go over to some guidelines. I don't have a lot of the fun stuff. I put some fun pictures of the group on some of the slides, just do that. And then I ran out of pictures of the group. So there's pictures of my family at some point. But the goal of this is to learn to each other's. We'll do bring your own lunch for now. If anybody has suggestions on how we can do it better, we can do that. And then we want feedback. If this is helpful, if it's good, we'll keep doing it. If it's not helpful, then we won't, because it takes a lot of time. And then there was a lot of I put together these slides. It took a lot of time, so people have ideas on how to do that better. We could do it with no slides. We could do it, have the team update on Google, whatever, Google Slides or other things. But so that's all that. And then so let's have some fun, because I think we can all have sort of questions and learn something from this, I'm hoping. So first, I wanted to have just some general stuff. The probably most important thing out of this is none of us are as good at the tax savings as the tax team. So if we have questions, send them to the tax team. And I think the opportunity is bigger for companies that have high profits year to date. So something maybe in the 50 to 200K range or something like that. There's a lot more we can do. They're sort of just breaking even, like a lot of our clients. There's not a whole lot of not as many tax savings. One thing that's just really easy to do that I think most people can communicate is timing the income and expenses. So this was just an old strategy, especially if they're cash basis. They can prepay rent for next year. They can prepay subscriptions. They can prepay contractors. They can prepay all sorts of stuff. We have I think one client that sends out a bunch of checks and does a bunch of stuff at the end of the year. Just anything you can do to have expenses pull forward. And then you can also not cash checks. If somebody sends you a check, don't cash it until January 1st of the next year, and that impacts your taxes. We'll get into a lot more stuff later, but that's just some basic stuff. And the goal of this, is not just, obviously if you lower your taxes and do this each year, you sort of just are kicking the can down the road. But where it becomes really important is if you're right on the edge of one of those tax brackets, which I don't even know, how the different brackets work, but I know that if you, are right on the cusp and you can do anything to sort of lower you to that lower tax bracket, then there's savings there. And then if we had one client right now that has a bunch of, they had a what do you call it, inheritance come in. This was actually last year in 2022, that inheritance come in, and they also had a lot of medical expenses that year. They had to do just out the roof, I think like $50,000 in medical expenses. And because of that, we took the inheritance all that in that first year versus delaying it out over 10 years, because they were sort of able to take advantage of that year's medical expenses. So there's just a lot of timing stuff. I'm going to stop for a second before going on. Are there any questions so far? Okay, I'll keep going. And then maybe when I get into the next slide, I'll come back to the big group for more questions. I'm gonna go through these other ones pretty quick. So Section 529, obviously you can save for education, health savings account. These are more just personal tax things that people that Jenny and team were bringing up, but you can put away pre-tax dollars there. And then there's new laws being passed, like Inflation Reduction Act. So if you install solar panels or different things, you can get credits. And so there's always things like that. So that's sort of on your individual tax return. So in getting into business tax savings ideas, I'll try not to read the slide, but you can, buy cars, you can buy equipment, you can do different things, and you can sort of depreciate that or expense that over the years. And so this is something you can do if you have a high profit, then it's like, let's go buy a new car, and you can do that. Michaela, I don't know if you're there. Is the CARES Act acceleration thing still going on, or is it just the Section 179 for this?
So bonus is slowly being phased out. So I think for this tax year for 2023, I'll have to double check, but I believe instead of 100%, it goes down to 80, and then over the next 4 or 5 years, they'll phase it out completely. And so then that's when Section 179 will come into play, because that will still be there.
Cool. And then the flip side of this too, we have some clients that have, they buy $100,000 worth of equipment, and they get a loan for it, and there's all that, but I think there's also the mixed side of tax savings is also profit, so there's that trade-off. There's always a trade-off between growth and profit and different things, so that's something else to consider. Lots of different tax credits. We do a lot of work on the R&D tax credits for people that have, are developing software or apps or things like that, and they save usually on their payroll taxes, as employment tax things, work opportunity tax credits. I'm not going to go through all of these things because you guys can research them. It's just meant to give a high level. Hiring a family member is a interesting one that I don't know a lot about, but I know that obviously you can, hire somebody, one of your kids, and I think it's like $12,000. If they make below that, they don't owe any taxes, and then you're basically sort of getting that money tax free, as opposed to paying yourself or things like that. Does that make sense, Michaela, or did I butcher that one?
I think the kitty taxes for earned income, I believe it's actually lower than the 12,000. I'll have to double check the exact amount, but the amount that's over the threshold is what's taxed at the parent's tax rate.
Does anybody know about the family LLC? And does that tie into hiring your family members? It's an FLLC.
I'll stop sharing for a second. You can see.
Oh.
What was your question, Rochelle? The family LLC, or what is it?
Yeah, there's like a family LLC, and I wasn't sure if that had anything to do with like hiring your family members and things like that, because I've considered opening one. I just don't know anything about it, so I was just curious.
I've actually not heard of a family LLC.
I would say when I hear the term, I think of it as like just a way to have some sort of entity where you can expense certain things, like, I don't know, office equipment, printers, things like that. But I think the risk with some of these things too, is if it's all just expenses, that's not a viable business. You can't just start a company and say, hey, we're going to charge all of our travel to it, and we're going to do all this stuff, and there's no revenue. Eventually, Michaela or other tax preparers will say, hey, this doesn't look like a business. It looks like you're just trying to
right.
I forgot the term for that.
They'll call it a hobby if it loses money for 3 or 5 years or something like that.
Okay, it's just a hobby. Okay.
What was your question?
Going back to the family member being an employee, does it have to be your child, or could it be like a parent that's retired? Could it be someone that's 40 years old? Is there like a requirement there?
it's just any way to say to have an extra expense. So it could be a cousin, it could be, it doesn't matter. It's just like
It doesn't
anybody
matter.
who would pay. Well, I mean, the full disclosure that for the most part, when people are hiring their family members, it's our kids are all super young, and they don't have their own bank accounts. The money just goes straight into my bank account, and that's the way it's sort of set up. We only have one of our 3 kids on payroll, just because it's I don't know the way it works. But I mean, and then the other part of it, you have to have a business reason for them. So you'll see, throughout our website, whatever else, I have pictures of our kids. So that's probably the best use, because if you're going to pay somebody for a picture, pictures cost $500, $1,000. If you're paying your kid, $1,000, that seems to be a good thing. If you have them do filing, if you have them, do emails. My daughter's going to take lessons from Elle one day on Canva and do some other stuff. Whatever they want to do, but you can't just, there has to be some, something that's workable. Stephanie, what was your question? And then we'll come back to Elle. She has other ones.
I basically was going to say what you just said. Like when you I know hiring your kids is kind of a popular thing to do, but it has to be reasonable and customary within like your business. So like I can't hire my kid $100 and pay him $100 an hour to file when I would pay someone off the street $10 an hour. So it kind of has to fit within the norms of your business.
Cool. All right, let me get back to Sharon. Great discussion. And I'm not able to see if people raise their hands, so I'll keep popping back and forth. And we'll get into more of the details of some of the stuff. There's also this qualified business deduction, which I think is sort of an offset. Michaela, you can keep me honest, but this was sort of like S corps have a certain benefit, and I think some of this took away some of that benefit, but I don't know.
I think it just pretty much, I don't think it took anything away. It just added an additional deduction under the CARES Act. So pretty much as long as it's not an SSTB, you're allowed to take this. I forgot I think it's like 30 or something percent.
Looks like 20 is what I used ChatGPT for some of these bullets, so we'll have to double check that the percentages are correct. But yeah, I think that's
20%. That's what I took last year.
okay. So yeah, so we'll keep going through these pretty quick, and then we'll I don't know, see where the conversation takes us. This is one of the ones just to call out, which is just it's not necessarily tax savings, unless you can create things in this 100% deductible category. So there's some benefit if you're classifying expenses as holiday parties, summer picnics. A lot of times companies will just have either a line on the chart of accounts that says 100% deductible, or it's holiday parties or something like that. So there's those need to be separated. And this is changing as of 2023. For 2022, there was different percentages because of COVID and stuff. Entity structure is another interesting thing. I'd say a lot of people call us or we talk to people, and my general advice is do an LLC at first because it's easiest and cheapest. Once you know you're going to get investors, if you're going that route for angel and VC money, then C corps are better because it helps them from their tax standpoint, which we'll cover later. And then you can always migrate to an S corp. I don't know what the exact cutoff is, but 50 to 75K. Once your profits are big enough, you can migrate by filing this form. You need to file that form by March 15th. I'll get Michaela and Jennifer and whoever else to weigh in on sort of the when to switch to an S corp. But the reason why it's beneficial is then you pay yourself a reasonable salary, and then you can take the rest as dividends. So it's sort of like that owner draw thing, but you also have the salaries, so that we're not having to do the I forgot what you called it, but the quarterly estimated taxes and things like that. But you're able to have some savings, and these dividends are sort of where those savings come in. You pay yourself out, you don't have to pay taxes on it. Elle had a question earlier about why some people, have medical and gym and tax payments and why those are treated differently. And so as an LLC or I mean, really, medical expenses like, going to the doctor and co-payments and all those medical bills, those are usually not deductible under any entity. But insurance, medical insurance is deductible. And then there's always a question sort of for like gym and other things like that, typically for I don't know, I'll get feedback from people, but for a larger company, they're able to write off some of those companies. But if it's just sort of your gym membership, you're not able to for some reason. And then tax payments, if you're a C Corp, those are deductible. If you're, I think, an LLC or an S Corp, you're not. So I'm going to stop sharing because I probably said about 5 things wrong in that slide presentation. So anybody that wants to weigh in and correct me, debate it, go ahead. Maybe I'll start with a question, Michaela and Jennifer. When do you recommend people switch to an S Corp? Is there a dollar threshold or something? Is it sort of?
I do about 75,000 also. And I actually did a whole analysis of one client just because I wanted to be able to give people figures. Because, it does cost more to have an S Corp. You have to do a corporate tax return. You have to pay for payroll processing fees and everything, but you get to deduct half of the self-employment taxes. And the client that I did, this was about 10 years ago, I did an estimate on, I only paid him $2,000 a quarter out of his S Corp. So it was a very small salary amount. But after doing the whole analysis, he still saved $800 on his taxes just on that small salary. So it can be a big savings to do an S Corp. But yeah, there's so many small businesses that they need to start out as a single member LLC, and then because there's so many businesses that don't make it, and then they have all the extra costs of the payroll and the S Corp tax return and everything. So,
and also just to add the amount of payroll that an S Corp issues like a proprietor. So how much they can contribute into their retirement funds is actually based off of that as well. So that's another thing to kind of like, let's say that they pay themselves, I don't know, I think it's 25% of payroll. So there's like that maximum of what they can put in. So the higher their payroll wages are, the more they can put into like an after tax before tax plan. And also that amount is deductible to the S Corp as well.
mm-hmm.
Which will also bring down the tax liability.
We've got a slide on retirement later, so we'll go into that.
Sorry.
No, that's great.
I had a question really quick.
Elle, what was your next?
Just a really quick question. I know that when it's tax season, you guys are so busy and you're working almost defensively with whatever has already been done for the year. But if you see, like if you just eyeball it, can you tell the person they should be an S Corp and they go ahead and make the change before you file the taxes? Or would you set them up for the following year?
It has to be filed 2.5 months. Oh, sorry. 2.5 months. Yeah. Into the tax year for the current tax year. So, or they can do it when they first set up, they can do it throughout the tax year, but there is a time limit. There are exceptions. So if they just didn't know, or that there's ways to get around it, but typically they have to file the form to become an S Corp within the first 2.5 months.
Okay.
And the other part is they wouldn't have been paying themselves payroll taxes if they weren't an S Corp, so or payroll. So there's a few things that it's more for like the next year. Stephanie, do you have a question?
So yes and no. I'll go ahead and ask it. It's been my understanding. So please correct me if I'm wrong. Like things like gym memberships, things like that. Like if it's, it can be deductible if it's offered to every employee. But if I'm the owner and I just want to expense my gym membership, but not yours, then I can't. Is that correct? Do I understand that correctly?
I think you can, as long as it's included in the W-2 income.
Okay.
For the employees. So if you want to give them all of this benefit, they would have to report the income for it.
Right. It would be like like the reimbursable, whatever.
Right. It would be
Non-monetary. Okay.
Yeah, under code 14. And in that case, then yeah, the business can deduct it, but also the employee would have to claim that as income.
Sure. But it has to be offered to 100%, well, like whatever, 100% of employees who qualify.
Right. It can't just be, yeah, just like the business owner gets to deduct his lifetime fitness and nobody else does. Yeah.
Perfect. Great question. Learning a lot. Let's go on to the next slides.
Oh, and also really quick with the health insurance for S Corps, that's also only deductible if it's included in a W-2 for the owner.
One quick question. Both of those things you brought up, how do we make sure that info gets into Gusto or QuickBooks payroll, or is there a, because I don't know if one, I don't think it's coming up very often, but is there, I'm sure there's a way to do that in the payroll. You might need to get Cheryl or somebody to help explain that.
Last year, Christine had me go through all of my S Corps and add it in manually with a correction in Gusto.
Okay.
They do have an item set up in QuickBooks for this self-employed health insurance deduction. So there is an item set up.
Okay. Let's go on to retirement accounts. This is a busy slide. How to make it bigger. And so this is one of the, again, we'll break out and discuss it because there's a lot here. But I think the first thing that I've heard is that, and maybe it's subject to that 25% of payroll rule that Mikhail was talking about, but I've heard this position from financial planners as basically you can deduct as much as you want if you set it towards retirement, but we'll have somebody fact check me on that or correct me because I'm sure that doesn't sound right, but I don't know. That's how it's been presented as a sales pitch from them. But anyway, so there's different types of retirement accounts. So it's important to know those a little bit. So the SEP stands for self-employed plan. That's best for small business owners with few or no employees. There's contribution limits. So there's the 25% that Mikhail was mentioning. And then there's a few other things. There's also pre-tax versus post-tax. And then I hear all these things about, Roth and traditional, which anybody can set up, but then there's a backdoor Roth, which is where you might not be eligible for a Roth, but then you convert to a traditional, and then you convert it to a Roth. And then there's the mega backdoor Roth, which just sounds really cool. But I think it lets you get extra money in there. So let me not go through this slide because let's just discuss it instead. So I guess first, like in terms of how much you can deduct, is it really the 25%, or are there like loopholes around with all this sort of backdoor Roth stuff, or is that sort of the minimum amount?
It depends on the plan. Like the SEP, that is the 25% max. I think the maximum is the lower of 25% or whatever the 2023 amount is. I forgot it already, but I don't think there's a loophole around that. And I'm not familiar with the rest of the plans. So it's not very helpful with this. Usually I go to Jeremy.
Okay. Yeah, so I think that, so again, this is more just, none of us are going to be experts on this, but the high level is if companies have a profit and they paid themselves some sort of payroll, they should be able to then save money for retirement. And that full amount is then a deductible expense. And then just so I understand it, like are the matches or other things like that, is that all like considered income? So they're basically just going to end up, are they skirting paying any, Social Security or, taxes or things like that? Or are there other things? Or, because I've heard this sort of pitch is like, this is a great way to save on taxes, but I don't really know. It's more just the fact that you have a retirement account and you're not paying taxes on the interest or the, the what do you call it, accumulation of wealth. But are there other things that I'm missing here?
I mean, I know when we do like the C corporations with pretty high profit, there's that employee part of it, which is the 25%. And then there's also an employer match that we can do on top of that, and they're both deductible. But that has kind of a lot into play. Usually the software just figures it out if you put in the maximum. So I'm not sure what the exact specifications are if I rely on the software too much, but I do know for like Schedule C plans, we use both like the employee, employer, and then also the same for like profit sharing for S Corps. And if somebody's more knowledgeable, feel free to step in.
Or if people have questions as well.
I typically tell people to, because I know that there's a general pool of product out there for IRAs and everything, but I tell them to check with their IRA advisor, whoever's setting it up, because there's going to be different products with different companies, and they're going to be able to tell them what would be the best. If it would be, typically they want the pre-tax and then, the deduction, and that's what I set up usually for people, but I have them verify everything through their market house or whatever you call that, where their guy that's setting up their retirement account for them. I just have them verify how they should do it through them based on their income. So, because I'm not real I can't advise on that very well either. So.
Yeah, but we had one client, I think it's more fun to tell some stories or whatever, but they actually I don't know how to say it, put money into their accounts. So they had an owner investment to then pay themselves more payroll to then put more money into retirement for whatever. I mean, it's because they were trying to do all these different things. So there's other things like that might be helpful, but I think it's definitely worth another tool in the toolbox, I guess.
I'm curious. Go ahead.
I just wanted to quickly say that we do work with Lee and Jeremy Davis a lot, and they're usually who I go to if a client has questions or with kind of structuring their retirement plans, because I'm not that familiar, so I rather send them to somebody who is. And so they're also a source for us if they are looking for an advisor. I would send them there.
Yep, no, they're great.
Mm-hmm.
Thanks for that plug.
I had a question. Is it beneficial for tax reasons to have multiple retirement accounts? Like a universal life policy or something? Is that deductible? And if you have a Roth, or, well, I guess that's after tax, but.
So life insurance is not deductible, and that's because when you receive the proceeds, you don't pay tax on it.
Okay.
As far as, it's always good to have a variety of retirement plans. The difference is with the traditional IRAs and 401ks, they defer your taxes now, but when you do take that money out in the future, you're taxed on it. So it's kind of like you're saving money now, but then when you're 70 or whatever, you're going to be paying taxes. With the Roth, right now you don't get a tax deduction, but also when you take the money out, it's tax free. So that's kind of the off part.
Okay.
So it's definitely I always advise people to have both, just because, let's say that you have just a 401k plan, you distribute money from it, then that's all taxable. But if you did set aside money for your Roth, which grows up until you retire, then none of that is taxable. And then also with the Secure Act, another thing is with I think we briefly touched on the 529 plans. So let's say that they're not used for education. Those can now be converted into, I think up to 10,000 can be converted into an IRA account as well. Oh, and then
so how does that work? Okay.
Oh, sorry, with the HSA plans too, I think now if you don't use all of the medical expenses and it just continues to grow, once you're at the retirement age, you can start taking that money out for non-medical uses, and it's just like taking money out of a IRA where you're taxed on it, but you're not penalized.
Oh, that's awesome. I have an HSA. That's good news.
I thought the HSA had to be used that year.
Mhm.
No.
No, and the HSA continues to grow.
Okay.
You just can't have a HSA plan without a high deductible medical plan, or you just can't have an HSA account without a high deductible medical plan.
But when you leave the company, you still have it. And it will be under your individual name. You just need to pay administration fee every month.
Correct. Yeah, that money's yours. It doesn't go away.
How does that work with a nonprofit? Like, how does the retirement plans and everything work with a nonprofit and employees and stuff like that? Because I don't know. I know Val has, like, one of the clients has a nonprofit, and I'm just curious how that works.
I worked for a nonprofit once, and we didn't have, so it's like a 403B plan as opposed to a 401k. That was like 20 years ago. That's all I remember.
I think
I'm a
educators have that
nonprofit
too.
too, and they have a regular retirement account, and they can deduct it just like a normal corporation.
Yeah, same, just different name. I think it's 403. That's why I have.
Perfect. Great questions. Yes, so it's okay. Let's go to the next slide, and then we'll see what other questions come up. Okay, this one's a good one. So real estate's another big category that people can use. One is obviously if you have your personal, your own house you sell, you can get a tax break on that up to $500,000 if you're filing jointly. And then for rental properties and things, you're able to depreciate those properties, the sort of building value of it. I think there's another slide later where I'll ask some questions about depreciation. So we'll talk through depreciation in the second slide, or maybe I'll do them both, and then we'll just come back to this idea of real estate. So basically, if you buy a property, you're able to take that depreciation expense. So even, like I said, even if the property is positive cash flow, you still might have a sort of tax loss. So that's good. 1031 exchanges are awesome. I know we've done a couple where basically you take the capital gains instead of paying capital gains, which I can't remember the exact percentage. Was it 15 or 20%, Michaela? Or Jennifer?
I mean, it's kind of, it depends. So I'd have to look more into it, but I know if it's like the same cost, kind of like the whole thing is deferred, but then the basis is lowered for the new property. So once that's sold, you kind of recapture all the gains that were deferred before. So
Right.
technically with a 1031, there really shouldn't be a taxable gain or loss in that year.
But I'm saying if you didn't do the 1031 exchange that year, then you would pay like 15% long-term capital gains. I don't know the right percentage. I don't know.
Oh yeah, if there wasn't a 1031, correct, yeah.
Okay.
If it was held for more than a year.
Yeah. And then so basically, yeah, it's just a way to defer your taxes, and you get to buy other properties and things. And there's all sorts of rules around like timing of when you sell one and buy the other one and different things. So we won't get into it, but just know that you can do things tax-free. Another part of just nothing to do with taxes, but more just why I like real estate investing is you can leverage it. So think if you buy a house, you put 20% down, and then the property, I think the long-term appreciation of property is closer to 2%. But if you look at like the Denver market or things like that, it's much higher than that. So if you say if it's at 4%, that's a 20% return per year. Plus you get these depreciation benefits. So there's a lot of benefit to sort of doing that. Plus you pay down your mortgage. So I like real estate a lot. Appreciation. I'll try to give this the best that I can on this. The goal of depreciation is to spread the costs out over multiple years. So you buy some equipment, and it's, you know, the life of that equipment is 5 years, so you spread that over 5 years. There's this schedule over here on the right. You know, office furniture is good for 10 years. You know, IT systems are good for, I don't know if it's which of these is 6 or 5 to 6. There's different years for all the different things. Rental properties are 27.5. So I'll put that there. And then one quick note, just in the purpose of learning, amortization is the same thing as depreciation, but it's more for an intangible asset, which would be like if they purchased another property, or sorry, another business, that amount they pay for the business would go there. If they buy some, sometimes software or things like that, it can go there. Or if they build their own software, sometimes that gets categorized as amortization instead of depreciation. There's a crazy calculation for all these different things. You can do straight line, which is the same amount each year. There's this Macker's acceleration where you can see like year 1 is 20%, year 2 is 32%. You know, it changes each year, so it accelerates it a little bit. But the good news is the tax software does all these calculations. I think in all of my years, I might have done 1 or 2 of these manually because we were trying to get the like journal entries in. But so that's good, just to let the tax software do its thing, and then you just put the journal entries in after the books are closed. Land can't be depreciated. That was a question that Elle had. And then I put a link. I'll send out the slides after this, but here's a link to, you know, this thing that's like, you know, all the different properties and things like that. Basically, what I would do is just Google it and say, you know, what's the useful life of horses or whatever else. We have one company that has horses. So yeah, okay, let me stop sharing. We'll come back to real estate and depreciation, which was a topic. I heard one question, but then I think it maybe went away. So who had a question?
I did, but it was answered. Thank you.
Okay, perfect. Must have had some good slides then.
I had a quick
Good.
when you have rental property and you are doing the work yourself, can that time, can that mileage, can that work you put in be deducted? Because like my husband's a plumber and he's like the handyman guy, and so he'll go and fix all the stuff at the rental property, but I don't know if that his time is deductible or not.
Yep. Yeah. I'd say in general, but you have to figure out a way to make a transaction that will show up in the bank.
Right.
And then if you're paying him money as a contractor, then he would get a 1099. So it's sort of a circular reference a little bit where you're sort of lowering
So
rental property.
Sorry.
You're paying, you would have to report that on your personal. But if you have an expense like you can definitely deduct your, you know, cell phone or mileage, or, you know, if you pay to have a repair done, you know, you can do that, but you just have to, you know, it's a expense that has to hit the book somehow. You can't just get a free expense, I guess.
Okay. So let's say we had to buy new filters for the swamp cooler, but his time is not deductible, but the filters for the swamp cooler would be deductible, is what you're saying.
Correct.
Yep. And his time could be deductible if you send him a check for, you know, $1,000. So there's a bank transaction, and then you send him a 1099 at the end of the year for $1,000, and then you would pay taxes on that. So somehow if that extra effort would save you money, which I don't know how it would, yeah, it just seems like an extra pain.
Yeah.
But that's the thing. And so sometimes for people that are in that in those lines of work, they'll have a separate LLC for their plumbing business, and then it's like then they can send invoices back and forth. Like we have lots of companies that have multiple companies, and they're sort of doing that. Stephanie.
Yeah. So the I think the threshold for depreciation is like $2,500 for stuff, and mainly because probably anything under $2,500 is not really worth the depreciation. But I've still seen people try to depreciate their $500 computer when they purchase it. So just something to keep in mind.
Yeah,
Awesome.
for tax, I'll see that and I'll just expense it. Like if there's something depreciated for like $1,000, I'll just remove it and then just put it as an expense. Yeah, so when you're doing like bookkeeping and then there's something under $2,500, don't add it as a capitalized asset. Just expense it.
Awesome. Yeah, great point. Any other questions on real estate depreciation?
So I've always done 10% for the land allocation, and I think Michaela said you guys do 20%. Is that right?
I do 20 as a, yeah.
Is that what you do, Paul? Or I mean, what is your thoughts on allocating the land out of the purchase price?
Yeah, I think it depends. You go back to the closing documents and you sort of look through it, and you can sort of make an assessment on what it is. If it's something on 20 acres, that's different than if it's a house on a much smaller plot of land. So you can sort of, I don't know. I'm not a professional at this, but I think that you can sort of make adjustments if needed. But it's if it's in a lower income part of Denver, it might be different than if you're in Cherry Hills or something. So there's all different things. And then the other piece of it too is, this is going way too much into real estate details, but your insurance has the same thing. So it's like if you buy $1 million house, it's like what is it going to take to if the house burned down, what's it going to take to repair it? And if the land value is 500,000 of that, you can lower your insurance premiums by saying, hey, it's only going to cost us 500,000 to repair this house. But obviously there's a risk of that if their house then burns down and wood prices have gone through the roof and you can't find contractors and all that stuff. But there's different things to think about in that split of land and property.
Okay.
Or you can pick a simple approach. You can, when we pay tax, they do assessments on your land and property value and you do percentage.
Yep, for sure. Yeah, there's that paperwork too. And then we know I have some contacts for people that had their house appraisals or whatever, I don't know, or the assessments go up. And so there's ways to fight that, I guess.
I just fought mine and got mine lowered. 180,000 in the mountains because they said my house went up from 427 to 870. Like there's no way. So you can just fill out the form and send it in, and I got about 180,000 off my assessment. Thank goodness.
Yep, you can do that. And there's some firms that we know too that help with them. All right, let's go on. We got go ahead.
Back with the depreciation, another thing to consider is like, let's say you have a rental property. Let's say it's, you purchased it for $100,000 and let's say you do have like a 10%, 90%. So 90% of that is depreciated over time. But then when you sell the property, let's say you owned it for that 27 years, your basis is now only that 10,000 left, which you didn't depreciate. So if you sell it for 200,000, your basis is only 10,000, so you're going to be paying a gain of 190,000.
Mm-hmm.
So that's kind of why I like to keep it 20/80 is just have that buffer. Like when it is sold, there's still that 20% remaining that that's part of the basis that doesn't go down because you do have to pay back all that depreciation you took when you sell the property.
Right. Gotcha.
Unless you do a 1031 exchange.
I have another question. When you do things like redo the windows, replace things like that, is that deductible or no?
Mm-hmm.
Or is that just off the purchase, like when you sell it?
So are you paying somebody to do the windows? So usually if it's over that $2,500 threshold, I'll capitalize it. Put it on the balance sheet instead and just take depreciation instead of just doing an expense for, if it's $10,000, you can't take the $10,000 expense, but you would just depreciate it over the 15 years or however many years.
Okay.
But that does add basis to the home. So let's say you bought it for 200,000 and now with the windows it's worth 220. So that raises that basis as well.
Okay. Okay. Thank you.
But if you expense it, say 10,000, you use bonus depreciation, so you have loss. Because we always say today's money worth more, so it might be worth it to go down this route instead of put it into basis.
Yep. Okay. Good point, Fitness. The thing I always tell people is taxes are timing. You're either going to pay it today or tomorrow. Most people would prefer to pay it tomorrow. And so you can play these games and sort of kick it down the road as much as you can. But like Mikhail was saying, when you sell the property, if you don't do a 1031 exchange or something, then you're going to have to pay it. And then eventually somebody's going to sell it and not do a 1031 exchange or whatever it is. So I've got a bunch of slides that are super high level, random, not very common things, but I think it's fun to know about things that you can impress clients with, I guess, or something. I don't know, your friends at the dinner party. Opportunity zones is one. This was basically if you invest in certain areas, then you can defer or exclude your capital gains, but you have to hold the investments there for a long time, like 10 years, I think, or something like that. So that's a really cool thing. It's also really hard to find these opportunity zone investments. There's funds and people that invest in it and things like that. So just a cool thing to know about. There's trust and estate planning. There's all different types of trust. So there's revocable. I don't even know all different types. But essentially you can, you used to be able to put money into these trusts, and then you wouldn't have to get the step up in basis, and you would defer some things. But I think the IRS changed some of those rules. And there's also some annual exclusions, the amount you can give your kids or people. And then this is always big news. And if these amounts ever change, because then all of a sudden people start scrambling for help trying to figure out how to get money to their kids without having to pay gift tax. So there's a lot of stuff there. Angel investing is another cool thing. There's a law, section 1212, that basically says the gains from so if you do a $10,000 investment in a company and it sells, for 100,000, you don't have to pay capital gains on that after you meet all these rules, like hold it for 5 years and do a bunch of other stuff. And there's also some stuff around stock and other things like that. So there's lots of other things. There's some other tax loopholes, which is these. I don't know if these are loopholes or not, but I saw this one thing about basically if you buy a bunch of stock, say the stock goes up and you put up whatever $100,000 in the stock market, it goes up to $1 million. The second you sell that for $1 million, you would pay tax on $900,000 as a capital gain and have to pay taxes on that. But if you take that to the bank and say, hey, I've got $1 million of stock, can I then use this money as collateral to take out a loan? So then you take out a loan of $500,000, you don't pay tax on that loan. It's sort of just a loan, and you can use that money to buy stuff or live off of or do things like that. So there's just that was an interesting idea, which I think people do a lot. And that's actually, when you see people paying cash for properties and things like that, that's usually what they're doing. They have an account somewhere where they have this account that they're borrowing against. There's a vacation property thing where if you can rent it out for fewer than 15 days, you don't have to pay tax on it. Okay, so let's get back. I think we've got 8 minutes to discuss all the slides, and then we'll turn it over to Rochelle for sort of a fun way to end the call.
I guess, is that how people like the high up, like Elon Musk and stuff, is that how they have no income tax? They just borrow against their companies or something, and they just live off that and pay it back? I don't understand how that works. I guess then they borrow against their gain.
They borrow against because he has equity in the company. So his equity worth some money. So the banks is willing to lend him money. I was thinking about that too. It's working for people like him because basically he calculates, okay, if I get paid, how much tax I need to pay. But if I borrow in this way, how much interest I need to pay. But for us, it's different.
Well, and Elon Musk, like, he gets paid a very small salary, but his compensation package is stock options, where he has the availability to buy so much stock for pennies on the dollar. So that's how he's accumulating most of his wealth.
Okay.
Which would be great. I wish I had that option somewhere. Finance Pals stock options.
Yes.
Yeah, that's what people want. We'll try to figure out something. And there's lots of other phantom stock and other things like that companies do to figure those things out. Any other? So we covered a lot. Any questions? Things we didn't cover?
I know some S corps like to rent their house back to the company for, like, there's that 15-day threshold. That's a very gray area, but some people do it. They find the loophole in the tax code. So
You can't rent to yourself, right? Is that your business?
You can.
Oh.
You just have to report the income on your Schedule E. So I actually have a few clients we do this with. And usually I do the rental amount just enough to where it offsets their depreciation. So they don't, on their personal returns, like let's say they have 10,000 of income, but then there's 10,000 of depreciation that will offset that. So that's zero income to them. But for the business, they get that $10,000 deduction.
Okay.
They have to do an accountability plan also if they do that. So
What is the benefits of that? I'm curious.
Just a deduction for the S corporation. So then on their K1s, it's lower by this rent amount.
So it's like you're renting office space to yourself. So technically, like, you know, if you had a brick and mortar office that you drove to every day, you would pay rent on that. But if, you know, you're working from home, you don't have a rent expense. So it's a way to capitalize on some rent expense. And like Michaela said, kind of offset some of that stuff on the personal side too.
Okay. I think that'll be a separate meeting because I'm a little slow, but okay. Okay. But thank you.
You can listen to it again or you can research it. So
Yeah.
Cool. Any other closing thoughts? And then I'll stop recording and turn it over to Rochelle. Okay, let me stop recording.